Hello and welcome to Module 15. This is the program summary of the Fractal Energy Masterclass. In this video, we're going to do a quick summary of each module. What did we go over in this program? And then we're going to focus on how to get started from here. We'll talk about transitioning to live trading, and then we'll finish up with running your investing like a business. In Module 1, we talked about what is broken, what is wrong with today's market analysis. Using the same old analysis techniques for new markets might not create the edge that we seek if the movement of the market does not match the signals that are produced from these legacy technical systems. This is what I found over the years, is that markets are moving differently now. Module 2, what are fractals? So this is the first thing we need to answer is, if we have a program called Fractal Energy Trading, what on earth is a fractal? It's important for us to understand how fractals really apply in what we see in real life on day-to-day, as well as in financial markets. And that's what we did in Module 3, is what we applied these fractals specifically to financial markets. In Module 4, we talked about how markets have fractal trends. So inside of a larger time frame swing, we'll see a smaller time frame trend, and we see this over and over again. Module 5 is where we did some single time frame examples for price. This is where we got down and dirty with a price and understood how to see trend within a single time frame, as well as potential reversals on a single time frame. And so in Module 6, we went to fractal price examples and looked for those trends and reversals. We talked about how 2 or potentially even 3 time frames fit within each other in that fractal relationship. Module 7, we brought in the concept of market energy, how range expansion leads to range contraction, and just about everything that we see in life. And then in Module 8, we showed how it applied to markets in financial markets. Module 9, we put everything together with fractal energy trading. So not only multiple time frames, but also energy at each time frame. And then Module 10, we went over examples on how to apply that. So that is fractal energy trading. So we added a few more on top of this. Module 11, we talked about risk management, which is really important. Doesn't matter how well you can analyze something if you can't protect your capital. So we went over 2 main rules on how to protect your capital, as well as showed my favorite style of trading, which is to define your risk at the very beginning of the trade, fixed risk trades. Module 12, we went over different forms of directional trading for crypto. Module 13, we talked about different market states. It's important that you understand that the current state of the market is not what it's always going to be. It'll be dramatically different a year from now, or 2 years from now, or 10 years from now. Markets always change, as do we. Module 14, we finished up with scanning, understanding how to screen through all those thousands of coins to come up with just the ones that we want to look at depending on our criteria. So I hope this program has shown you some new ways to look at markets from the inside out this time. The more you understand the concepts in this program, the more that you take the time to really dive between the lines on this, the more that you'll see them everywhere in any financial market. This is not applicable to just crypto. It's every single market that I trade works by these same principles. Now, if you've gotten this far in the program, and actually few people actually do get up to the very last module of the program. A lot of people get through it to the point where they satisfy their curiosity and they wonder why they don't get different results. Well, you're part of the minority. You've made it to the top, and you may be asking now, how do I get started with all this? Well, depending on your background, depending on how much trading you've done or charting you've done in the past, it may be a little overwhelming for you. There are so many things to learn. You might be tempted to rush through this and immediately start trading. I would say slow down or even stop. Please don't be in a rush to repeat your former mistakes and trade a financial market before you have a demonstrated edge. We need to build an edge that favors us. So when we enter a trade, we need to have a probability edge that it's going to work out in our favor. It took me a long time to really understand how to weave together all the puzzle pieces of the different time frames together to make sense of them, to understand how conflicting signals and readings from the different time frames actually showed some of the signals that I was looking for. I hope I've been able to help you shortcut that process, but it will still take time to internalize before you can look at the uncertainty of the hard right edge on a chart and make sense of it. So many times I've seen students go through a program and they get all excited in that seminar that they attended, and everything made total sense in all the examples, and it was kind of teed up to make it look that way, to get them confident, perhaps to have them buy a program. And then they go home and they try to practice it on a live market, and all of a sudden people say, wait a minute, this is all different. This doesn't work. The reason why it doesn't work is because you haven't internalized it yet. You're not really open to seeing the signals just yet. It does take some time. So I want you to turn this from a hobby into a business. Here are some suggestions on how you can accomplish that. This is what I call the strategy development cycle, or this could be a business development cycle, could be anything, right? And we're going to start out with goals. We're going to set the vision for what we want to accomplish. So this is going to be up to you to determine, what do you want to achieve through your investing or trading? Is it going to be just simply to invest properly for the long term and to find assets that will appreciate over time and to put yourself in a position where you can aggregate a great deal of wealth? Perhaps that's it. Or maybe you've got shorter term goals that you want to create some type of a weekly or daily income from this. There's all different types of goals that people have. You need to have an idea of what's going to motivate you towards achieving. And I want you to do this by setting up a business plan. Actually treat this like a business, and don't just write up a business plan and then stick it up on the shelf, check it off and say, yep, done that. No, this is a business plan that you should be referring back to on a weekly basis and saying, how am I doing with my plan? Am I on track or am I off track? If I'm off track from my plan, why? Did I set the wrong goals to begin with? Or is my execution faulty? If you don't put a plan together, then this will end up being just another expensive hobby. It's cool, it's fun, but it'll be a hobby. It won't be a business. Treat this as if your future depended on this business. Next, we want to determine our rules. If we have these goals, we have to express them into a live market in some manner, and we can't just wade into it and feel our way through it. Or we can't just read the news and buy the hot crypto and chase after the FOMO of the day. We know that that doesn't work. This is probably why you're here in this program. So I want you to put together a separate trading plan from the business plan. You can have several different trading plans. You can have a trading plan for crypto, or perhaps it's going to be futures, or perhaps it's going to be something to do with the equity markets. It could be anything, right? Each one deserves its own trading plan, and it needs to come through rules. You have to enter entry rules, exit rules, trade management rules. How are you going to define your own actions on how you're going to trade this market? That is what a trading plan is. So as it relates to this program, regardless of whether you're trading breakouts or you're entering in the pattern, you're going to need some form of rigid trading plan, defining entries, position management, money management, and exits. Now, at some point, you're going to get some results, and I'll have some suggestions for you at the end of this video on how you can go about building kind of a rubber room to get started. So you're going to have some kind of results, and I want you to track the results and not just keep track of the winners. You've got to keep track of the losers too, because the losers are a gold mine for information on what not to do next. So I like to track my results in tabular form, showing the results of each trade, adherence to each trading plan rule, and overall results of my system. This is an example spreadsheet. And the first thing I want to tell you is that this spreadsheet does not represent a current live trading plan. So don't worry about what these fields are. Don't worry about what these are. Just understand the intent of what we're doing here. These are perhaps entries. So this is a different type of entry. Maybe a price action entry is going to be different from a pullback entry, correct? So we want to track the adherence to those particular rules. And what we can see is that the trades where we have a 1 and flag it with red is where we didn't do the right thing. And these over here are going to be more of trade execution rules as well too. Did we filter the trade correctly, or while we were in it, did we behave correctly? Did we do the right thing? And maybe this is where we're going to track adherence to those rules where we didn't quite execute as well as we could have. Okay, so we want to track these types of adherence to the rules as we go through the trade. So each one of these columns is representing a chance for us to score ourselves. And over here is going to be basically the performance. MAE stands for maximum adverse excursion, maximum favorable excursion. So in other words, this is like a directional trade. How far did it go in the positive direction that we wanted it to go? How far did it go against us? And what's the ratio there? So obviously we want the biggest ratio possible for this. And ratios less than 1 means that that's probably not a good entry. And then we have results over here that we can tabulate. Now, we'll get into this in a minute, but we're also going to tabulate the win rate, how much we won, how much we lost, and what our profit factor is. And I'll define that in just a minute. But I want to emphasize here, again, don't get caught in the weeds here. Don't get lost in the weeds and start focusing on, well, wait a minute, why are you entering at 10 o'clock in the morning and things like that? No, no, no. Understand that this is going to be based on your own trading plan. You need to identify adherence to the rules based on your own trading plan. So this does not represent a real trading plan or a real tracking sheet, right? This is going to be up to you to build. But what I want you to do is I want you to define the rules that you want to track against. You've got to identify rules that you need to track against for your own trading plan. And then once you take a trade, you have to understand the characteristics for it. Did you win? How far did it go? How against you or in the direction that you wanted it to go? What kind of result did you get? And then track your aggregate results up here. That's the intent of what I want you to do. So now we get into the next section of the strategy development cycle, which is corrections. There's a reason why we put a steering wheel on the car, right? We don't just point it in one direction and just hit the gas pedal and then hope that we end up at our destination. We're always making corrections. A plane that leaves LAX and is bound for Honolulu is off course 99% of the time, but they're able to stop within a dime of their destination because they make corrections all the way through. For every trade, there should be one main root issue that you can identify that prevented you from profiting on the trade. Being able to identify those issues will come with experience. At first, when you lose a trade, you're going to mark it down and say, well, it didn't go as far as I wanted it to go, and it actually went in the opposite direction. And why is that? And you may not know at first. And that's the goal here, is that you need to get the experience to understand, oh, I see what happened. I got caught in a weekly pullback on a larger time frame. That's why the price went against me. I waited too long in that trend. Waited too long in the trend. I waited for things to feel good. So with experience, you will start to understand the root issue, why you get stepped on a trade. And believe me, there is a root issue for every single win or loss that occurs in a financial market. So back to our sheet for a second. Now, what we will do is, as you start to fill in your sheet here and get some results, what you're going to do is you're going to tabulate things where it didn't quite work out. Things like this. So what we need to know is, what should we work on? A lot of people will look at a sheet like this and say, well, we need to work on all this at once. And I disagree. This is where we need to get into what's called Pareto analysis. Pareto analysis will show you, if you do the work on this, it will show you a histogram, that we have a histogram of 3 for this correct signal here. The next histogram in line is 2, and that's the ISL, or initial stop loss, and the last one is 1. First entry, or me too. So we're not really going to worry about this one over here. It's only a single instance. Perhaps it's just something that came along. And while this one is attractive to go after because there's 2 of them here, clearly half of the errors that we had for this particular trading cycle were based on us taking the wrong signal off of the price action entries. So wouldn't it make sense to utterly burn this one to the ground, kill this one, right? Take care of everything that relates to price action entries before we start to worry about other ones like this. This is what Pareto analysis is. If you've heard of the 80-20 rule, where 80% of your errors will come from 20% of the instances, right? So you can apply that towards just about anything. This is what Pareto analysis is, and this is why I will add these up and work on only the things that are showing the number one instance of error. And once you wipe this out, then you can work on the next one. Don't try to work on everything all at once. Have you ever noticed how sports is statistics mad now? Where you know the batting average of every player, you know the slugging average, you know the on-base percentage of every baseball player. For every kicker, you know exactly what their success rate is based on how many yards they are away from the uprights. I mean, I could go on, right? So everything is statistics and is performance related. So I kind of think we should do the same thing as well, too. I think we need to get used to ranking ourselves in terms of our performance, right? Because we should be our hardest critic, because the market certainly will give you a run for the money. So I do like to measure a couple of things. Now, some people like to go overboard with this. I like to do as little as possible to make sure that I'm keeping track of what I should be doing. Win percentage is a good start. Now, win percentage is important because if you don't have a decent win percentage, if you're a retail trader, you will get discouraged if it's too low. However, keep in mind that I can show you a system with a win percentage of 30%, which is extraordinarily profitable. If you've ever heard of the turtle traders in your readings, they typically will do that. About a 30% win rate, but outrageous profitability. This is why we need a second half to this, because win rate by itself is meaningless unless you really know what you're working on. Profit factor is another good one, though. So it does measure a form of expectancy. So this, we will define this in just a minute, but profit factor, if it's over 1, which is gross winnings divided by gross losses. So obviously anything over 1 means you're running a profitable system. That's just the bottom line right there. So what is profit factor? Well, again, it's the gross profit or the gross winnings divided by your gross losses. We're not factoring in commissions. You can, if you want to, you can get into net profit, net losses, but I like to just use the gross number right off the bat. So this determines the amount of profit per unit of risk. Anything above 1.0 generally indicates a profitable system. A very quick bottom line calculation that cuts through the clutter and everything else. So I recommend that traders shoot for a 1.5 or better. If you have a profit factor of exactly 1.0, that means that eventually you'll lose money due to transaction costs. So shoot for 1.5. If you have a profit factor over 2.0 that you can maintain for any length of time, you will earn a halo over your head. So it's very difficult to maintain a profit factor over 2.0 for any length of time. So shoot for 1.5, which is entirely realistic. You could have a profit factor of 2.0, yet have a small winning percentage. So this metric, to me, is ultimately more important than just winning percentage. All right, after you make your results and make corrections to those results, it's worth revisiting your goals. It's worth going through the whole system over again, because what you'll find is that when you make your goals originally, you may not necessarily know how you will handle them or how the market will handle them, and maybe you need to make a slight adjustment. So as you cycle through your business, do your original business goals still apply? Are they realistic? Are they achievable? If not, what needs to be changed? Do you need to change your approach or your trading rules, or do you need to go back and revisit your rules and maybe edit those a little bit? I would do these review cycles at least once a week, as long as you have several trades during that span of time to evaluate. Again, if you're just doing longer term holds, this may be months between different trades, right? But if you are doing intraday trading, you'll get a lot more feedback on what you're doing. When you spend the time to really dig into the results and evaluate your performance and your potential corrections, you will be bursting with confidence for the next cycle. This is how you internalize a strategy. This is how you make it yours. So what are your next steps from here? Identify a style of trading that you want to excel at. So we can use fractal energy trading for just about any style of trading or time frame. But I would pick one to start out with. Create a business plan for that system. It does not have to be perfect, but it should direct your further efforts, and you need to amend it as you change. Create a trading plan for the system, entries, trade management, money management, exits. Create a tracking tool based on your trading plan and chosen style of trading. Do some back testing by examining the system based on past data. Not too much though, because it will be different going forward because you're not factoring in you. So what would you have done had the chart been live? I perform this step regardless of whether I'm trading discretionary or system trading. Then I test the system live with either virtual or extremely small positions. The idea here is to see how the system works without you introducing stress to the system. So if you're trading big positions, that introduces stress to the system. This is why a lot of people say, well, man, I'm great on paper, but then when I go live, all of a sudden I make silly decisions. That's because you're consciously aware of the risk of the position. I like to get at least 50 trades worth of data in this manner, and we'll constantly refine the system as trade results come in. The first 30 to me are the trial. So this is where I work the bugs out of the system. The last 20 of the 50 are the, is the system ready to light up evaluation? So that's almost like the beta test, right? This is the dress rehearsal before we really go live. I then take the strategy live, but even at this point, I'm using a fraction of 1% account capital risk per trade. So I rarely, if ever, run a strategy at the full golden rule of risk management level of 2% per trade. Earn the right to trade larger positions. Keep them super small to begin with so as not to harm your capital base while you learn. Earn the right to trade bigger. The number one mistake that I see retail traders do is to not define their exits prior to entry. But the number two mistake is too large position size per trade. That is the conclusion of this module and this program. Thank you very much for working with me, and I invite you to go back and cycle back to the beginning again and go through it one more time, now for more meaning instead of just awareness. Thank you for participating. If you have any questions that I can help with going forward, please hit us up, support@ReadySetCrypto.com.